These are a few practice exercises for depreciation. We won't get through everything in the world, but this is a couple of them. There are some skills about figuring out what an asset costs. If anything that any cost that's incurred in getting the asset purchased, having it delivered, setting it up, getting it prepared so that you can use it in your business. All those things add to the value of the asset. They're capitalizable, depreciable costs. If you anything that you have, any cost that's involved in just maintaining the asset or using it throughout its life, they're just usually expenses. So let's look at these right quick. We paid $1,100 in sales tax on a new delivery truck. Well, you can't buy the truck without paying the sales tax. If you go to the store and buy eggs, say they're $1 a dozen, boy, wouldn't that be nice? When you get to the cash register, you're going to pay in North Carolina $1.07. 7 cents sales tax. And you don't go home and say, you know, I paid $1 for these eggs and 7 cents for the tax. If you pay, buy $100 worth of something and it costs you 107, you don't go home and say, I spent $100 on this and $7 on sales tax. The sales tax is part of the asset when you buy it. So $1,100 sales tax on a new truck, that's part of the truck. Insurance to cover accident or loss on the equipment while it's being delivered to you, that's also part of the equipment. You can't use the equipment without it being delivered. That's part of it. Accrued sales taxes at the time of a plant site was acquired. This is land, because the accrued taxes are taxes that have been accrued since January or since the beginning of the year, but have not yet been paid by the owner. So you'll have to pay him for those sales taxes, and that'll be part of the cost of getting the land. Any sales tax you pay after, any sales, property taxes, any property taxes that you pay the next year, those are just a tax expense. They weren't part of getting the land, they're just part of owning it. $19,000 for parking lots, driveways, etc. on a new plant site. Those are land improvements, not land itself. $400 to have your company name painted on the side of a delivery truck. That's part of the truck. This is a new delivery truck. However, if say 5 years from now you want to repaint it because it's getting faded, then that's just a repair. $60 motor vehicle license on a new truck. Well, that's a new truck, but the motor vehicle license isn't part of acquiring it. You can acquire the truck and have it ready to use. This is just a fee that the state charges you to let you run it on the road. That would be a regular expense. $1,050 for a 1-year accident policy, either prepaid expense or insurance. Prepaid insurance or insurance expense. Some books like it either one way or the other. Again, this is an insurance policy on a new truck, but it's for the next year. It's not to get it here. It's not while it was in transit. It's to be able to drive it. You can't drive your car on the road without insurance. At least I never have been able to. $6,000 for installation of new factory machinery. Again, that's part of the machinery. Until you get it installed and in a useful condition, it's no good to you. Installation and testing of factory machinery. It goes back to the equipment. Painting and lettering of a truck as soon as you buy it, that's part of the truck. Sales tax on machinery that's purchased, part of the equipment. Cost of landscaping, land improvements. Insurance premium paid for first year's insurance on the truck. That's either prepaid insurance or insurance expense. The broker's commission on land purchase. You can't buy it without paying him his fee, so that's part of the land. Cost of paving for a new the parking lot, that's land improvements. Architect's fee on a building you're going to construct, that's part of the building. And the cost of clearing, draining, and filling land, that is actually land. That is not land improvements, although it probably improves the land. It's not something that can be depreciated. It's not something that's going to wear out over time. You're changing the shape of the land, and the land is going to just stay right there. So that would be part of the land. If you were building a parking lot on it, or if you were putting up lighting or doing landscaping, then, or putting maybe you built a bridge over a stream or something, then that would be an improvement. But the land itself, just changing the shape of the land, is not not part of the land improvements. Let's see if I can make this thing happen. Okay, let's see. We got one more. Let's go to one more sheet here. This company acquired land to build an office building, and here's the cost. Let's exit that stuff. Purchase price of the property, of course, that's part of the land. The raising of the warehouse, they had an old warehouse on the property. They had to tear it down. It cost $6,400 to tear it down, but they sold some of the materials that they salvaged out of it for $1,200. So the net cost of raising the warehouse was $5,200. That's also part of the land. You can't build your building on it with an old ratty building laying sitting on it now. The attorney's fees for the purchase, also part of the land. The real estate broker's fee, part of the land. The architect's fee, now that's part of my new building that I'm going to put up. He didn't design the land, he designed the building. And then the driveways, parking lot, etc., land improvements. Okay, let's go from where we are to the next little sheet, and that is this little practice right here. There's 3 or 4 different methods. Oh, there's several different methods of computing depreciation, but we're going to talk about straight line right now. For the straight line, you need just a few pieces of information to compute the depreciation in a year. The cost of the equipment or building or land improvements or whatever. The salvage value, this is the value below which the asset book value won't fall. For example, if you buy a bulldozer, it costs you $100,000. You may use it. It may have a useful life of 7 years, but you may use it for 30 years. Worked for a company where we had bulldozers that were 30, 35 years old. They had been repaired and repaired and repaired and repaired, and they were still running. They had a 5 or 7 year useful life, so we depreciated them for 5 or 7 years, and then for the next 30 years it was just keeping them going. But when on the books, if you look, they all had a salvage value, maybe $5,000, maybe $10,000 for each piece of equipment, and so we had depreciated $95,000 of it. The other $5,000, the remaining $5,000, was the salvage value. Almost every piece of equipment has some kind of salvage value. Sometimes in problems it'll be 0, in which case you'll depreciate the whole piece of equipment. The depreciable value is simply the cost minus the salvage value. The useful life for straight line purposes is always, well, almost always in years. We can pretty well say that that's the case. And then finally, the annual depreciation is going to be the depreciable value divided by the useful life. So it's depreciated equally over however many years the useful life is. So this company purchased a new machine on January the 1st, handy, at a cost of $145,000. Estimated the machine will have a salvage value of $25,000 and is expected to be used for 20,000 working hours. Not our job. Since we're doing straight line, we're not worried about the working hours. We're worried about this useful life here of 5 years. So here it is. Let me get rid of a couple of lines on here. The cost was $145,000. The salvage value is $25,000. The depreciable value is $120,000. So we will take depreciation of $120,000. We will never depreciate this equipment below a net book value of $45,000. Has a useful life of 5 years, and annual depreciation is $24,000, which is $120,000 divided by 5. The rate is 20%. One way to do that is to in the straight line method is to divide 1 by the useful life and set it up as a percent, or you can divide the annual depreciation by the depreciable value. That will also give you the same rate, how much per year. Not really too important in straight line, but it'll be useful in other methods. So here we are, January the 1st, 2019, we purchase it. The beginning book value is 145. Let me get my cursor out of the way. The salvage value is 25, depreciable value is 20. 20% of that is $24,000, and the accumulated, that's the annual depreciation expense. Accumulated depreciation this year, total depreciation, total accumulated depreciation, easy for you to say, is 24,000, leaving a book value of 121. The cost minus the accumulated depreciation gives me my ending book value. At the beginning of the year, I start with a net book value. This is the asset minus the contra asset. The asset has a $145,000 historical cost. The contra asset has now a value of $24,000 accumulated depreciation. So we just go through the whole thing again. Nothing changes in this line except for the beginning book value and these two figures at the end. But at this point, we have taken, at the second year, we have taken 2 years worth of depreciation expense, totaling $48,000. So the $48,000 is the balance in the contra asset account, leaving us a cost minus the contra asset, or asset minus the contra asset, ending book value of $97,000. The entry looks like this. We would debit, oops, too much, debit depreciation expense and credit accumulated depreciation for $24,000. And we just do that each year. The next year, we start with a beginning book value of 97. Depreciation is 24. Accumulated depreciation so far, $72,000 for 3 years. And cost minus accumulated depreciation gives me the ending book value. The same thing for the third year, for the fourth year, same thing for the fifth year. And at the end of the fifth year, we have accumulated depreciation that is equal to the depreciable value. These two numbers are equal. This is the most depreciation I can take. I can't depreciate it anymore. The ending book value is the same as the salvage value. I cannot go below that ending book value. So at this point, I'm done depreciating this asset. Okay, let's take this same asset, $145,000 asset, and let's purchase it not on January the 1st, but on October the 1st. All the numbers remain the same in our little summary section, but this first year is going to change because we only had the asset for October, November, and December, so 3 months out of 12. The depreciation schedule looks like this. Instead of 24,000 the first year, it's 6,000. 3 divided by 12, 3 months out of the 12 months that we owned it that year. That's the first year's depreciation. So you notice that our book value at the end of the year is different than the book value was when we purchased it on January the 1st. And we go through the next year's a full year depreciation, the following year, the following year, the following year. These middle years are all full year depreciations. Then we have to tack on another partial year at the end with 9 months worth of depreciation. So this would be the 24,000 times 9/12 instead of 24,000. And you notice that the beginning, the first partial year and the last partial year add up to one whole year. 6,000 plus 18 is 24. So we still end up with an ending book value that is equal to the salvage value. the accumulated depreciation equal to the depreciable value, and we haven't changed anything except the amount of depreciation we took the first year and then the last year. Even though it's a 5-year life, in this case we have to depreciate it over 6 years, a partial year at the beginning and a partial year at the end, and 4 full years in the middle. And that's how we do straight line. We'll talk about doing units of production on another video.